you. Okay, so now we proceed to the IFRS 16. Okay, before we go to the IFRS 16, just a brief introduction to you all that why we have this IFRS 16. So before IFRS 16 lists to be implemented, we have one standard which is called IAS 17. Right? So this standard also talk about leases. Why we have this standard? Okay, this is based on one story. So the story is one ISB, the chairman of ISB company. I'm not very sure about this story, how true of this story, because when I studied IAS 17, I can remember until now because my ACCA tutor explained this standard by using this story. So that's why when you learn this one, then I also share this story with you all. So this ISB chairman, so he took the flight from one destination to another destination, right? So for example, from UK, maybe go to US. So this this chairman has nothing to do. So he read the annual report for this airplane company. Okay, class. When you read the annual report, you go to the SOFP and the SOPL. So this chairman found out that as an airplane company, there is no airplane mentioned in the asset. That means, if you are for example, you are the AirAsia, and then when people read on your AirAsia financial report, and there is no Airbus in the AirAsia asset. So this chairman found very weird. So he go and investigate about this thing, why we don't have the airplane in your account, and found out that the airplane company signed a contract with a Boeing company. Okay, Boeing company is a manufacturing of airplane. So he signed a contract so that this airplane can use the Boeing company flight, not buying, just use up the airplane flight and then to do the business. So in that sense, this airplane company do not recognize any asset in the financial statement. Okay, so with this story, you can identify, you can clearly say that you have two persons here. The first person is the Boeing company, right? Boeing company. So we call it as lessor. So Boeing company is the owner of the aeroplane. And then we have a second person, which is called like airplane company. And we call it lessee. So lessee is the user. So agreement. Between these two people, right? So this agreement allowed the lessee to use up the asset of the lessor. All right. So under the previous one, IAS 17, we separate it into two different lists. One we call finance list. One we call operating list. All right. So if you are the operating list, how to differentiate this operating list and finance list? Of course, you have the criteria to be met. All right. So we have 5 + 4 criteria. If you classify under operating list, it's very easy. You just debit your expenses, your rental expenses, and then you credit cash. Close case, right? If your criteria is met to be classified as finance list, therefore, first thing, you have to recognize your asset. Since recognized asset, you have to go for depreciation. Number 2, this is your asset because you sign out the contract, you need to make the payment. Because like, for example, I sign up to these A plans, right? I sign up for 3 years. So I already into the agreements that this is my company obligation to make the payment in the next 3 years. Therefore, I need to recognize liability. If liability, then we need to look at finance cost. All right, so criteria to be met. So this is for the lessee. As for the lessor, again, it will be the same. We have an operating lease. We have the finance lease. Same, we will need to go through the criteria. So the criteria 5 plus 4. So apply to the lessor, apply to the lessee. If this is the operating lease, that means you will have the rental income. But the asset still belongs to you. But if you are the finance lease, then you will de-recognize your asset and then you put it as a lease receivable. This one we will see later on. The problems, most of the problems is come on lessee. Lessor is no problem because the asset belongs to them, right? So for them to recognize the asset, it's still okay. But problems come to the lessee. So when come to the lessee, it means that because the standard allowed them to choose whether it's a finance lease or operating lease. And as an accountant, since my finance lease, I need to do so many things. Okay, to recognize asset and then do the depreciation, liability, and finance cost. So troublesome. So the accountant will try not to meet the criteria of this 5 plus 4. Because if I classify it as an operating lease, it's very easy. I just like need to recognize my expenses. So compared to the finance lease, we will call this one life of balance sheet. Because you're totally out from the balance sheet. That means SOFP, there's no asset and liability to be recognized. So due to these manipulations of the accountant, then they found out some of the financial scandal or forensic accounting. IAS 70 is one of the contributor. That means because of not to recognize as the asset and liability. That means you already signed up of your agreement, but then you don't want to disclose to the financial user. That means your liability has been understated. Right? In our accounting concept, we cannot, under the prudence, we cannot underestimate our liability. So due to a lot of things happen, so IFRS 16 come in. Leases. In the year 20, if not mistaken, it will be 2019. So when these leases come in, leases say, okay, because due to the manipulations of the accounting, so for the lessee company, you are not allowed to choose for operating lease. Whatever the agreement that you sign up to use up the asset of the other people, of course, you have a criteria, of course, you must record it as the asset. You must record it as the liability. Because of the agreement stated in the next 3 years, you have to make out the payment. So no more operating lease unless on the exception case. Now we always have the exemption case. So exception we will see later on. In what circumstances we will classify it as operating lease. Other than that, cannot. Right? But then lessor part remain, no changes. Okay. And this is the change in accounting standard. Therefore, at that time, it will apply retrospectively. in change in accounting policy. Okay, you will apply retrospectively. So I give you a very good example. You know, like the Speedmart 99, like all the McDonald's, if they are rented out their shop lot, I mean not rented out, they rent the shop lot. Previously, they just debit expenses, credit cash, very easy. But now they have to recognize the rented shop lot as the revenue. And then this item have to apply retrospectively. So you imagine how many trading company has been affected during these changes, I mean, the new standard implementation. So IFRS 16 come in, not for lessee, not to recognize operating list. That means you only can go for finance list. Right, so that is the theory. So basically, it's because of the underestimate the asset and liability. Also underestimate the expenses. Okay, that one is only have one expenses. Now you have two. One is depreciations, one is finance cost. And then because of the underestimate of expenses, your profit has been overstated. So profit overstated, it shows that maybe the company want to have a good performance, so it have a, I mean, that's the reason the accountant opt for operating list. So that's why with the new standards come in, no more. So let's look at the introduction. IFRS 16 require the lessee and lessor to provide relevant information in a manner that faithfully represent those transactions. So the accounting treatment as the lessee book is driven by the conceptual framework of the definitions of the asset and liability rather than the legal form of the list. That means this one, they talk about the substance over form. That means in legal wise, the asset is belongs to the lessor, but who are the one who use up? The lessee. Okay, so substance over form. As for the stakeholder perspective, right? So they said when under the listing, that means you can use up the asset for other people. So he said majority of the list asset and associated obligation to be recognized in the financial statement. So this is a significant change from the previous standard IAS 17, which criticized for the following of balance sheet financing. So he said, because of that one, so we have a new standard to be implemented. So while IFRS 16 have benefit for the user of the financial statement in terms of much more transparent and much more comparability, because since everyone using the same, I mean for the lessee, so easy to compare. And also because of this, we have to look at a financial ratio as well. I mean the impact towards the financial ratio. So for example, gearing, because now you recognize your liability, so your debt has been increased. Asset turnover, because of the asset has been recognized, and you have a profit margin ratio because the rent expenses are removed and replaced with the depreciations and finance costs. Right? So in some of the question in the ACCA, right, you need to interpret the analysis for the financial statement because bank often impose loan component when making loans to the company. That's why you need to look at your gearing ratio component. That means you cannot more than that level. If more than that, then bank will ask you to repay the loan immediately. So next, let's look at what is lease. Lease, as mentioned, it will be the agreement of contract, right? Where they allow the conveyance of right of use of the asset, the underlying for a period of time. That means you have the contract in how many years time in the exchange for the consideration, right? So the lease arises when the customer obtain the right of use towards the asset, where suppliers that control the assets you a service rather than the lease is right. That means if I allow you to use, but I'm the one still can control the asset. Therefore, this one is just a service agreement. It's not the lease agreement. Lease agreement, that means when I sign up to you, I tell you, okay, my car, my aeroplane, I mean, this aeroplane with the model ABC 102 with the car plate, okay, sorry, flight number 102, it goes to you. So you have the right towards the 102. So that's why he put it the underlying asset, which is specific one. If not, if I still have the control over 102, I can change. I don't want to let you, I change to 103, 104 like that. Therefore, it is not the list. So to identify the list, the entity must identify whether the contract contains a list. So that means that whether this contract gives the rights to control the use of the identified asset. Must be identified. Huh? That means it's a confirmed car or confirmed asset. And also right to control the asset where throughout the period of use, the customer has the right to obtain substantially all the economic benefit from the use of the asset. That means, like for example, this is the common one. If you are taking as a Grab driver, all right, you sign out the contract with the Grab company. So the Grab company give you two options. Every day you come to Grab company to get the car. Wherever the car is in the Grab company, then you just go and take it, and then you can go and earn your money. The second option is you sign out the contract, and then the Grab company give you the right to use the Myvi 1.5 special edition with the car plate ABC 1234. Okay, that one is fixed. That means the second option is a fixed one, and then the first option is depends on the day that you come to the office, whichever that is in my office, then you can use. So therefore, so option 2 is the identified asset. Options 1 is not an identified asset. So that's a 2. So cannot meet the first one, so this is not the list. And then the second thing is both, I mean, once you get the car, right? Wherever you go out and then you take the Grab, I mean, you take the order, you send the customer, wherever you receive the money, then that we call as the economic benefit. Right, so that's why identifiable, right to obtain substantially all the economic benefit and rights to use direct use of the identified asset. So you must fulfill these two, only you can say this is the list. That's why for my example just now, both I can earn the money, but the first option, I cannot identify my asset. It depends on what car it is in the company. Therefore, for the first option, it is not the list. But for the second option, because the agreement stated clearly, I'm using Myvi 1.5 special edition with the car plate ABC 1234. So therefore, it is identifiable asset. So for the second option, that is list. For the first option, that is service agreement. Okay? That's why he come to the next explanation. He says that you can control the asset. So if the item, even if the item is specified, a customer does not have the right to use the right of asset if the supplier has the substantive right to substitute throughout the period of use. Okay, this one another situation. So I have the first one on the day. Second one, I could go for ABC 1234. So this situation says that if I already mentioned the asset, but then Grab can change anytime. That means they say, okay lah, today you use ABC 1234, but tomorrow I think cannot lah. You have to change the other one. For example, therefore it still cannot be considered as identifiable asset. So meaning that when you read the question, you must read carefully whether it's a service contract or whether it's a lease contract. So I give you the illustrations one. You read 5 minutes, 2 minutes will do. Then you see why it is the least. Okay, you look at this question. Corktown Council has entered into the 5-year contract with Clarfeet Co., which is that Clarfeet supply the council with 10 vehicles for a community transport. Okay, Corktown Council basically is just like our DBKL, or in Kajang, it will be DB Kajang. Am I right? Bandaraya Kajang. So that with the Corktown Council. So that means our DBKL enter into the contract with a company to use up the 10 vehicles for the purpose of community transport. And Clarfeet owns the relevant vehicle and all 10 which are specified in the contract. Corktown Council determines, you see, Corktown Council have the right that determines the road taken from community transport and the charges and eligible for the discount. That means you can identify the fare, how much they charge, where's the road from, the lane from this area to another area, some kind of that, right? And council can choose to use the vehicle for the purpose other than the community transport. That means if one day I want to withdraw, I want to go for become a city bus, also can, so it can change the purpose. So when the vehicle are not being used, they are kept in the council office. So park at DBKL and cannot be retrieved. So you look at this word, cannot be retrieved by the Clarfeet unless Corktown default on payment, unless your council cannot pay, therefore the Clarfeet has the right to take back. So if the vehicle needs to be serviced or repaired, therefore Clarfeet is the one to provide the temporary replacement vehicle for the same type. So from here, first thing you can see, the council have the right to choose how they're gonna use the vehicle, so that all the substantial economic benefit is flowed to the council. Number 2, all vehicles are already specified in the contract. Number 3, Clarfeet cannot simply take over. That means Clarfeet cannot say, oh, today I want to change, next day I change another one. No such thing. So with these 3 points, it is clearly stated that this is the list where identifiable asset, period of contract, Clarfeet does not have the right to substitute any of the vehicle unless it's being serviced. So with this, council need to recognize asset and liability in the statement of financial position. So class, that's the reason I read the illustration with you, so that when you go for an exam, you sometimes, right, you really need to look at the words that used by the question, because the word hints you. Then you look at the second illustration. 2 minutes reading time. Quick one, huh? Okay, you see, for this illustration too, Brooktown Council has recently made a substantial cuts into the community's transport service. It will now provide such service only in cases of great needed. That means maybe the transportation, no one wants to use. So therefore, they cut out those not popular one, and then they only remain those needed one. So assess on the case-by-case basis. It has entered into the 2 years contract with the Flitcar for the use of one of its mini bus purpose. See, I use the word one. Use the one of the mini bus purpose. The mini bus can sit 10 people, but Fleet has used any of these 10-seater minibus when required. So the last sentence basically is mentioned that it is not identifiable asset. Right, the asset is not identifiable. Because the asset is not identifiable, therefore it is not the list. Where the Flitcar can exchange one minibus for another. So because of this one is just a normal service agreement. Service agreements is nothing to do with the lease agreement. Okay, and then we look at the second one. It can be separating multiple components of the lease contract, right? So this one is how you look at the lease. Some contract may contain both lease component and the non-lease component. So in other words, it can include the amount payable by leases for the activity and the costs that do not transfer goods or services to the lessee. So this activity and cost might be, for example, including maintenance, repairing, and cleanings. So therefore, IFRS 16 requires the entity to account for the lease component of the contract separately for the non-lease component. Why? You have to always remember that lease component is for you to identify the asset. What is the amount to be recognized in the asset? Right? And the non-lease one will be maybe, because it's for the maintenance, so it will park under the P&L. So entity must split lease component and the service element separately in the P&L. So how to allocate it? He says is based on the standalone basis. How standalone? Okay, let's look at the illustrations 4. Livery Co leases a delivery van for the Beatles Co for 3 years for 12,000 per year. This payment including service cost. Livery could lease the same make model for a van for 11,000 and would need to pay 2,000 for the services. That means if I go for other people, car itself, right, the van itself is 11,000 and I need to pay for the 2,000 for the service. But then because I sign up with this Beatles, this Beatles give me some discount. So in order to package it, I mean, BT-list package it into 12,000. So this 12,000, including the service component. So in order to split this 12,000 into your account, it says that we need to separate it in the list component by using the standalone basis. So how to calculate standalone basis? So it's goes to 12,000 with your accounting with 11. That means 12,000 times 11 over 13,000 like this. Because the 11s represent if I go for car only. 13,000 is car plus service. So this one, this item is come from standalone basis. Right. As for the service one, then you just continue with another 2,000 one, so 12,000 times 2,000 over 13,000. So this will be the nonce list component. So with this one later on, you have to do some calculation in order to recognize as your asset. And then these ones will be your P&L item. And we also look at the period of time of your contract, right? That the lease term, we call it. So lease term, if the contract itself mentioned about non-cancelable period for the right of use of your asset, right? Together with the option, option to extend the lease if the lessee is reasonably certain to exercise. That means if I give you like, if you go for rental in Sungai Long, I'm not sure about you, but last time when I'm in Sungai Long, I mean, my rentals is 2+1. 2+1 means that I have the option to extend, that kind of thing. So if the other have option to extend and my chance is very high to continue, therefore, I should take into the consideration of the options to extend. If the option give you options to terminate and the lessee high chance to not to exercise the option, you also need to take into the consideration. Okay, so how this go? It says that a lease contract for the 5 year with a lease payment of 10,000 per annum, and the lease contract contains a clause that allowed the lessee to extend the lease for further of 3 years with the $5 per annum. So as it is unlikely for unlikely the lessor would be able to lease the asset to another party. So economic life of this asset, it will be approximately 8 years. That means 5 plus 3. Why we concerned about the lease term is because the lease term is for us to calculate depreciation. You know, when we calculate depreciation, we need to divide by useful life, right? But since the asset is not belong to us, therefore, the useful lives will be based on the term, unless you have other condition where we will see later on. Okay, after we talk about the lease, now we look at the accounting treatment. So we start to the calculation. It says that on the commencement date, that means at the date you sign the contract, the lessee shall recognize the lease liability and also right of use of asset. So this is the name given in the standard ROU asset. So in your annual report, next time if you read people's annual report and you find out that they have the ROU, so meaning that that is under lease agreement, right? ROU. So how to calculate lease liability? And it says that lease liability is initially measured at the present value of lease payment not paid at the commencement date, discounted as the interest rate implicit in the lease. For the that means calculate your percentage, a bit like your present value things. And the rate to borrowing over the similar time of security to obtain the asset similar value. So this lease liability cash flow to be discounted, including the fixed payment, that means your monthly payment, or it can be the variable payment. So for example, increase under the CPI, amount expected to be payable under the residual values of currency. So this is happen where a lessee is guaranteed the lessor that a asset will be worth for a specified amount at the end of the lease. So that means after the lessee use it, that this asset still has some value, unless the previous example like 5 + 3, because the lessor have no right to lease the asset anymore. That means no value. Then we have a purchase option if reasonably certified to be exercised. So with that, the lease liability is being recognized and subsequently measured by increase the interest and reduce it by the payment. So I will give you the formula later on. If this is the asset, right? Therefore, it will initially measured at cost. This cost include initial measurement of lease liability. Can you see this one? That means whatever that you calculate at the beginning on the lease liability, the first part that you need to put in will be lease liability in your ROU calculation. And then maybe when you sign out, you need to make some payment at or before the commencement date. You have an initial direct cost like the legal cost, by a professional legal fee. And then you need to pay any estimated of dismantling or restorations cost. And after that, under the IAS 16, because this is your asset, therefore cost minus accumulated depreciation and impairment in accordance with IAS 16. So I give you the diagrams over here. So whatever that you calculate here, which is summary from the previous one, you will come in and become part of the ROU calculation. Okay, part of the ROU calculation. Then you proceed with the ROU. Okay. Next part, we go for this one. Sorry. ROU asset. So now you already identified the cost. Now is depreciation time. So right of use of asset is depreciated from commencement date at the earlier of end of the useful life or end of the lease term. And then he put the bracket. End of its useful life if ownership is expected to be transferred. So what does it mean? Meaning that if you go for your depreciation, right? Depreciation of your ROU asset, you will choose the lower of, or here we call it earlier lah, or shorter. Sorry, choose the right word, use the right word so that you can memory. The shorter of lease term. Second one, useful life. Okay. So if, put a star here, You will choose useful life if the asset is transferred to, sorry, let's see, at the end of this term. If the asset is transferred to the lessee at the end of the lease term. So meaning that, if your example, if my lease term is 4 years, my useful life is 5 years. All right. So my depreciation's useful life is divided by 4 because this is the earliest, this is the shorter compared to the useful life. But if my contract says that at the end of the year, that asset is belong to me, so transfer to me ma. So therefore, when I go for my depreciation, I will choose 5 instead of 4. Okay. So that's the things that you need to know. So as a conclusion, lease liability you have 2 steps. Step 1, calculate the present value of lease payment, which is not yet paid. That's why it's liability because you yet to make the payment. Step 2, because the standard say increase by the interest, reduce by the payment. So I will call it as amortized schedule. So I will have, if the payment is made, just put it here, payment is made at year end. So I will have opening balance, interest, payment, closing balance. So my step 1 will be my opening balance for year 1. All right. Number 8, payment is made at beginning of year. Therefore, OB, opening balance, payment, interest, closing balance. S1 student. So formula, this one plus this one minus this one equal to this one. So payments always minus. What's this one? Equal to this. Like this. So after you calculate this is lease liability, the next one we look at asset. ROU asset. So ROU asset, I will put it as S3. S1 plus things initial payment, initial direct cost, one more, cost for dismantling, then step 4, depreciation. So depreciation shorter of system useful. Then put a star here. The star will be same as the previous one. So useful life. Unless the assets is transferred at the end, then we use useful life. Can class? So far, so good. Okay, if okay, we look at this question, right? We only up to this part. The second part, it will go for the second item. At first, I want to go for your illustrations one. Then I found out your illustrations one is much more similar to your activity one. So that's why I choose activity one instead of illustration. Because in activity, you have more things to cover. So let's try on this activity one by using the step 1, step 2, step 3, and step 4. Right? So you look at this one. Let's say PLC lists the item of the equipment on the following terms. So you start out with commencement date 1st January, X0. Lease term 5 years. The lease payment 1st January X1. Right? That means you start to make the payment at beginning of the year. See, just now that I write correctly, beginning of the year, which is 200,000 per annum. Interest rate to be 6.2%. Right, 6.2%. So next one. The present value not paid on 1st January 20X0 is 690,000, and the price to purchase the asset outright would have 1.2 million. So the next information is just to graph you lah. All right. Then inflation, okay, inflations we'll see later on. Okay, we will see later on. So you see, since you're gonna use S1 to S4, so we just start with this one. S1, lease liability. No need to calculate because the question already give you 690,000. If you are required to calculate, then it will be 200,000 divided by 1.062, power of 1 plus 200,000, 1.062 power of 2 plus 200,000, 1.062 power of 3 plus 200,000, 1.062 power of 4, like this. If you are required to calculate. Because this one, it says that your payment is already given 690,000, so you don't need to calculate. And then why I only calculate for 4 times? Because the moment you sign this one, you already make the payment for your first payment. That means the moment that you sign on this contract, you already paid 200,000. So for 5 years, you paid 200,000. So you remaining another 4 years not being paid. So that's why not yet paid. All right. Okay. Next one. If it is not given, so since the question gives you 690,000, so you no need to calculate this one. So removed. So we have the S2, amortized schedule. So we have X1, opening balance, beginning of the years, right? So I have payment first. Then I have 6.2 interest. I have closing balance. So opening balance 690,000. No need to have the payment. Then I calculate my percentage. So 690 times 6.2%. So I get 42,780. So I get 732,780. Then I continue my X2, 732,780. I minus this 200,000. Then I got this one, 33,032. Five, 6, 5, 8, 1, 2. Then X3. And I have 5, 6, 5, 8, 1, 2, minus another 200,000 times 0.062. Sorry, I do some calculation since I didn't ask you to do. So no more, because the last year you already make the payment at the beginning of the year. That's why your last amount shall be 200,000. So this amount round out figure. Okay, can we just do S1 to S4 first? Yeah. So when come to the, okay, why we need to prepare this one? This is because this amount will be your cash flow payment. Remember just now we just learned the cash flow. So this will be the lease payment. This one, SOPL, finance cost. Or maybe you can tell it as interest expense. Then this one, SOFP. Asset, sorry, non-current liability, current liability. The amount to be reported. Then we have the step 4. Step 3. My ROU asset will be equals to 690,000 plus 200,000. Why 200,000? Because at the beginning of the year, you already make the payment. So makes sense lah. You see, my payments over here is only 4 times ma. Where is another 1 time? That means the moment you sign out, the moment you already make the payment. So this is my initial payment. Right. That it will become 890,000. So my step 4, depreciation equals to 890,000 divided by 5. Why 5? Because you only have 1 year's information. The question didn't mention that what is the original of this useful life. So you divide by 5, you get 178. Can so far so good? Any questions so far? Since no, other than this one, let's look at the journal entry. All right, let's look at the journal entry. So based on the question, for the journal entry, JE, we have initial recognition, which is on 1st January 20X1. So I will debit ROU asset, 890,000, credit lease liability, 690,000, and then credit cash or bank, 200,000. Subsequent measurement, which is example 31st of December X1. So what I can do, I will credit my cash, debit my finance cost. So debit finance cost with the amount of 42,780. Credit my cash or bank, 200,000. And can you see my account cannot balance one? So the cannot balance one, we will debit to lease liability with the balancing figure. So 200,000 minus 42,780. 157,220 like this. So if you want, you go for the second year, it will be the same. Debit finance cost, 33,032. Credit bank or cash, 200,000. So 166,968. So this is initial recognitions and subsequent measure. Okay, class. So far, any question? You need to know how to prepare step 1 to step 4, because the informations that you're gonna use later on for the following sections it will help you to identify any changes, then how we do the adjustment. Okay. Next.
Miss, sorry.
Yeah.
Can I ask a question? Why
Yeah.
on the amortized schedule, the X1, there's no payment, then there's
Because
initial payment?
this one, why there's no payment? Because the questions, it says when you sign your on 1st January, right? You already make the payment of 200,000. That's why he said annual lease payment commencing on 1st January X1. That means when you make your payment, your rental payment is at the beginning of the year. That means 1st January, I make the payment. 1st January, I make the payment. So that means the moment I sign out, I already make my payments of 200,000, right? So my present value of the lease payment, which is not yet paid, is only the remaining 4 term. Okay.
Okay, thank you.
So you want to try if your payment is paid at the end of the year. Because if the payment is paid at the end of the year, you will use this schedule. Basically, it's the same, just the payment go after that. So your opening balance times with the interest, then your payment is made of the year end. So slightly change on your S1 and S2. This table, you will see this table again in IFRS 9. Basically, this table, and why I use this table, because I love shortcut class. This table is your T account. This liability. So opening balance, closing balance, like this. So since you make the payments, right? So payment is here. And then your finance cost is here. So this is a T account. Basically, it's your T account. That's why you increase, according to the standard, you increase by the interest and you reduce by the cash payment. So this table represents the T account. Okay. Okay, next one. Okay, for the second part, come to this one. Optional recognition exemption. So this is under exceptional case. So IFRS 16 provide the optional exemptions for the two requirement. So the standard state, we cannot go for operatings, right? Operating lease. But IFRS 16 say can. You can go for operating lease under these two conditions. The first one, it must be the short-term lease. Where the short-term means that less than 12 months. Right? Okay makes sense If your short term is less than 12 months, how can you recognize as a non-current assets, right? So he said less than 12 months, then you can park under operating list. Number 2, your underlying asset is a low value. So how low is low is not mentioned, but according to the KPMG, it's less than 5,000. That's why he put it personal computer, small item of the office furniture, and the tenant. So your list of the asset, the value is too low. So he said, okay, never mind, because it's immaterial, insignificant amount. So you can put it as the operating list. All right. However, if the entity elects for the exemption, lease payment recognized as the expenses on the straight line basis over the listed. That means you divide. Why divide? You say why under 12 months? 12 months, 1 year, why you still need to divide? Because sometimes it can be in the middle of the year. right? So you need to prorate it. And then you also need to look at the assessment of whether this underlying asset of the low value is performed on an absolute basis based on the value if the asset it is new. So meaning that we look at the value of the asset just now we mentioned, which is less than like for example the 5,000. But somehow you need to look at the value of the asset as its own. Like for example, based on the illustrations 4, the entity lists a second-hand car with the market value of 2,000. Because it's a second-hand car, so it is 2,000. But everyone knows that the value of the car as an absolute one, that means if you really buy a car, it cannot be 2,000. All right, it cannot be 2,000. Therefore, car itself cannot treat it as the low value asset. So that's why he put it as a absolute basis. That means you need to look at the nature of the asset when you go for it, not just because of the value. Like if I can say everyone will go for the asset which is below the 5,000 ringgit, and then they charge under operating lease. So you just go and rented it out for 2 second-hand one. So that's why to avoid all these things, so we will look at the absolute value of the original of the asset. That means the nature of the asset rather than the value. Okay. Next part, we look at the remeasurement. Okay. Our liability can be remeasured, right? If necessary, on any reassessment of the amount payable. So sometimes when you sign up the contract, right, your tenant, I mean your lessor says that, oh, your lease payment will be revised based on our national CPI, customer consumer index. So he said the revised lease payment are discounted using the original discount interest rate. That means the percentage where the change relates to the expected amount on the residual value guarantee, or payments linked to the index rate, or revised discount rate when there is a change in the lease term, purchase options, and payments linked to the floating interest. So when we change in the terms and conditions, right? Therefore, there is a change in the lease liability. Due to I need to pay more, therefore my liability has been increased. So we need to recognize the changes in the increase, right? So when we record it for the changes, we also need to adjust to the right of use of asset. So for example, if the interest is increased, I will debit ROU asset and credit lease liability. Example, if payment so how does this go? Again, go back to this question. So he says that inflation measured by the Consumer Price Index CPI for the year ending 31st December X1 was 2%. So we have an inflation of 2%. As a result, lease payment commencing from January X2 rose to 204. That means previously you signed is 200,000, now become 204,000. So the present value of the lease payments of the remaining 4 years become 747,300 using the original discount rate. That means because of your payment has been increased, so you revise your liability. Definitely your liability has been increased as well. So under these circumstances, space. You see, according to the question, beginning of the year, they said the present value of the lease payment for the remaining 4 years is become 474,300. So this one, beginning, that means this one. So beginning will become the closing. It will change to 474,300. But what you have calculated is basically 732,780. So this difference, we will call it remeasurement. Okay, we will call it on remeasurement on the lease liability. So because of this, you will debit ROU and you will credit lease right here, not space. Okay, debit ROU asset, credit lease liability. So you have to make sure it is increased from 730,780 to become 747,300. So I got 14,520. 14,520. All right. So because of these changes, class, this amount shall change. So I change to 747,300. And now my payment is 204,400. Right? And I need to calculate my percentage. Okay, calculate a little bit. So I got 33,685. So 576,985. So you see the pink color ones is all the new depreciation. Depreciation. It's a new changes due to the remeasurement. Okay. Okay. After you change your liability, so you change it, huh? See, my asset, my ROU asset, carrying amount will equals to 890,000 minus my original liability. And then I add another 14,520. So I calculate. Okay, I got 726,520. So this is my new carrying amount. So this new carrying amount, I need to go for depreciation. So 726,520 divided by 4. Why 4? Because 1 year already go for depreciation. So I just got this one. Divide by 4. So my new depreciations for X2. So this one also for X2. It will be 181,620. Am I right? Oh, sorry, 630. Then next one. Okay, this one done. Okay, this one for you to read. Reading. Skip. Okay, next one we talk about deferred tax implication. Since we have the changes, right? So you talk about the assets and liability, then we also need to look at the deferred tax implication, right? So how this deferred tax being calculated? So just for your information, for the deferred tax, quick one, summary. You need to look at the carrying amount and the tax base. So we only got two situations, CA bigger than TB or CA smaller than TB. If this is asset, it will be DTL. Then DTA, liability, DTA, DTL. Right, for you to identify. So under this one, deferred tax implication. So under the list, the lessee recognize a right of use asset and the corresponding lease liability. So therefore, we need to go for net figure represent the carrying amount. So we only go for one. So if an entity is granted the tax relief as a lease rental are paid, the temporary differences arises as the tax base of lease is zero. That means tax on tax information, they will not recognize it. So it will be zero. So therefore, this result as a deferred tax asset. Why asset? So I give you the example just now. This one, sorry, too many things. So my first year, we compare year one. Year one, my liability is 732,780. My asset, wait, 712, like this, right? So I bring to here, 712,000. Then the other one is 732,780. So obviously, my liability is higher than the assets, which is 20,780. So carrying amount bigger than TB, so DTA. So when you get this one, you compare. So it will be 20,780 times the percentage, example at 20%. Therefore, times 0.2, I got 4,156. Like this. Just as simple as that. Simple calculation. Right? Okay, so next one. Okay. Activity 2, defer tax. I give you 15 minutes to go for the S1, S2, S3, and S4. Prepare S1, S2, S3, and S4. Then only we go to the deferred tax. So the deferred tax will be considered F5 lah, S5, right? Just calculate. No need to go for explanation. I scared run out of time. So let's try this one. 15 minutes, so by 2, 3, 7. S1 to S4 first, yeah? To make sure you know how to calculate. Let's try. Explanation, I think I will by verbal. Okay. Class, how? I need answer from you. Bear in mind the question only required until 31st December 20x1. That means your amortization schedule only need to prepare for 1 year will do. So no need to prepare until X4. Okay. So can I have the answer from S1? Lease liability. And this is from the question, 24 million. So S2, what is your closing balance amortization schedule? So I want closing balance figure. Then after that, step 3, ROU asset. Step 4, depreciation. So you give me S2, S3, and S4. You don't have the answer. Someone please share your answer. You don't have the answer because you didn't prepare or halfway prepare. Never mind. Just start with the OP, 24 million. Then we will have the, you cannot remember how to do it. Okay. There are too many calculations for today. Okay, never mind. So let's look at this one. So I have a OP, then I have a percentage of 8%. Then I have the payment. Then I have a closing balance. So my closing balance is 19.9 million. With my ROU asset, we will start with the 24 million, but I have 0.4 direct cost. So I just add on 0.4 million. So I get 24.4 million. As for my depreciation, okay, class, I have two different years. One is 5 years, one is 4 years. So which one I should choose? 5 years or 4 years? 4 years. Yes, you are right, because we choose whichever is shorter. So I got 24.4 divided by 6 is 4 years. So I got 6.1 million. Okay, after I calculate this 6.1 million, so at the end, my ROU with my carrying amount equals to 24.4 million minus 6.1 million. So I get 18.3 million. So plug this information into my DTA calculation. My asset, 18.3 million. My liability, 19.9 million. So I got the figures, which is 1.6 compared to the tax base, 0. So 1.6 at 20%. So 0.3 million. So DTA. So therefore, I can start with my explanation because it said discuss with suitable calculation the accounting treatment for the above transactions for Heiki's financial statement for the year 31st December X1. So I can start with the liability first, since I start with S1, right? So liability shall be initially recognized on 1st January 20X1 at the present value of lease payment not yet paid at the commencement date. So which is 24 million. After that, for the subsequent measurement, an annual finance cost of 8% of the amount shall be recognized in the P&L and added to the liability. Lease payment on 31st December X1 shall be deducted. So when you make the payment, then you deduct from the liability. This derives the closing balance of the lease liability at 31st December X1 amounted 19.9 million. So next, ROU asset. So ROU asset of 24.4 million shall be recognized in the financial statement. This amount comprises the 24 million of the present value of lease payment, which is not yet paid, plus the initial direct cost incurred in the setting up of lease, which is 0.4 million. The asset should be depreciated at the earlier of the end of the useful life, 4 years, or the lease term, which is 5 years, unless the legal of the title is transferred to the lessee at the end of the lease term. So therefore, depreciation charge of 6.1 million shall be recognized in P&L. This derived the carrying amount of ROU at 31st December X1 amounted 18.3 million. So after this, we proceed with the DTA. So the DTA, it says that the carrying amount of the financial statement will be net off based on the ROU amount and the lease liability. So I get 1.6 million. As the tax relief is granted on cash basis, therefore the tax base is 0. So this gives rise to the temporary differences. The result on DTA shall be recognized at 0.3 million. Okay, that's it. So you just follow what you have calculated from step 1 to step 4, additional to the DTA. Then we proceed with the lessor accounting. Lessor accounting, not much difference because most of the time tested it will be the lessee, but no matter how, we still need to understand about the lessor accounting. So under the lessor accounting, we still maintain the 2 classification, which is the finance lease and the operating lease. So if this is the finance lease, where a lease receivable is recognized in the statement of financial position, and operating lease, which has accounted for rental income. So finance lease, it says that it will be the lease that transfers substantially all risk and reward incidental to the ownership of the underlying asset. That means risk and rewards has been transferred to the lessee. However, for the operating lease, does not transfer the substantially risk and reward to the lessee. So how we know that it has been transferred all the risk and reward? So he give you 5 examples. Remember I mentioned 5 plus 4, right? So this will be the 5 plus 4, sorry, 5 plus 3. So another one is not in, revised a little bit. So back to here. The lessee, sorry, the lease transfer ownership of the underlying asset to the lessee by the end of the listed. That means at the end, the asset will belong to the lessee. Therefore, you will park under the finance list. Next one, the lessee has the option to purchase the underlying asset at a price to be expected sufficiently lower than the fair value at the exercise date. So because it's lower value, so therefore it's reasonably certain the option will be exercised. So finance lease. The lease term for the major part of the economics life of the underlying asset, even if the title is not transferred. So meaning that, like for example, my asset is 4 years useful life, but I rent it to you is 3 years, so 75%, so major part of the economic life. So if you look at the majorities, right, normally we will say it's 2/3 lah. 2/3 meaning that 66.67% is considered major part. And then the present value of the lease payment and the inception date amount to be at least substantially all the fair value of the underlying asset. That means when you calculate the present value, you calculate. If your calculation, the fair value is substantially all, that means it's almost the same. So we call it about 90%, right? Therefore, it is a finance list. Then the last one, underlying asset is such specialized nature that only this lessee can use. So additional could lead to become the finance lease. Like for example, any losses and cancellation is by the lessee. So that's why lease and rewards has been transferred. Gain or loss of changes of the residual value occurred to the lessee. And the lessee can continue to lease for a secondary term for the rent substantially lower than the market rate. So benefit goes to the lessee. Therefore, all these can be the situations where risk and reward has been transferred. So how the lessor gonna record it? So we look at the first one. It says that for the recognitions and measurement, on the commencement date, at the date that the lessor made the underlying asset available for the use by the lessee. So that means you fulfill the criteria that mentioned just now, the 8 criteria. Once it's confirmed it's finance lease, the lessor will de-recognize the underlying asset and then recognize as receivable at the amount equals to the net investment in the list. So what is a net investment in the list? Present value of lease payment received by the lessor. That means present value of the lease payment paid to the lessor, plus one more special one, present value of any unguaranteed residual occurring to the lessor. So you add up these two, that will become your net investment in the lessee. So once you get this one, you get the amount, right? So you will debit lease receivable, right? Where you use the amount net investment in lease. Then you credit your asset. That's why D recognize the underlying asset. Any differences, debit, credit, if you have, go to the P&L. You will consider as you dispose of, and then the people will make the payment to you on the annual basis. Okay, so that's why when it's considered disposed of, right? So you need to de-recognize your asset. Consider you sell, right? Next one, new words. What you mean by unguaranteed residual value? So unguaranteed residual value is a portion of the residual value of the underlying asset, the realization of which by the lessor is not assured or is guaranteed solely by the third party to the lessor. That means just now remember that when you recognize as the finance lease, right, the lessee has the right to purchase. Here, have the right to purchase, which is sufficiently lower than the fair value. So that means since I sell to you at the lower price, so the price which is guaranteed. The unguaranteed one is the amount. If I sell to the third party, maybe I can sell at the higher price. So the difference between the amount paid by the lessee and I sell it to the higher price one, that will consider as a unguaranteed, right? Unguaranteed residual value. So that's why under the explanation, arises where the lessor expected to be able to sell the asset at the end of the lease term more than the minimum amount which is guaranteed by the lessee. So this amount guaranteed by the lessee are included in the present value of the lease payment by the lessor. So there will be always received. So only the unguaranteed amount needs to be added on. So once you get this one, since you de-recognize your asset, you recognize as a lease receivable, since it's under the present value, therefore we will have to recognize finance income. So again, class, the same table will be used, just that just now what you calculate is under liability. Now you calculate is under asset part. So therefore is finance income. So reflecting the constant periodic growth or return with the investment in the lessee. And the derecognitions and impairments required on the IFRS 9 are applied to the net investment in the lease. That means derecognition, that means when come to the term 4, year 4, you already, lessee, when you rent out, right? The lessee makes a payment to you. So to be derecognized, or your either fully payment, either not yet, no receipt. So you may need to calculate impairment of your lease receivable, because it can be the chances that your lessee don't want to pay you. Right. So if this one, then you will follow the requirement which is based on the IFRS 9. Okay. Let's go for the illustration 3. Discuss the accounting treatment for the above list in the financial statement of Ever Leasing Co. for the year ended 31st December X5, including relevant calculation. Work to the nearest of 0.1 million. So let's read the question. 5 minutes. Not very difficult because it is similar to your activity. Sorry, it's similar to your illustrations 5. That's why 5 and activity 3, choose one. So let's read the question. 5 minutes. let's look at the question. So Able Leasing Co. arranged a financing arrangement for its customer for bespoke equipment acquired from the manufacturers. Able Leasing based on the item of equipment to a customer commencing on 1st January 2025. Expected economic life of the asset, it will be 8 years. The term of lease were 8 annual payment with 4 million commencing on 31st December expired. Commencing on 31st December expired means that your payment is paid. Sorry, your payments is gonna receive now because it's the lessor, right? So receive at year end. The lessee guarantees that the residual value of the asset at the end of the lease will be 2 million. Although Able Leasing expect to able to sell it for third party for 3 million. So you see, lessee only promised to buy at 2 million, right? So if I sell outside, I can go for 3 million. Therefore, 3 minus 2, I have the 1 million unguaranteed residual. The present value of the lease payment, including the residual guarantee, is 25.9 million, which is under the 6.2%. This was equivalent to the purchase price. So you are required to discuss the accounting treatment of the above lease in the financial statement of the Able Leasing Co. for the year 31st December. So under this kind of question, step 1, because you need to talk about the accounting treatment, and under lessor, we also need to differentiate whether it's a finance lease and operating lease. So we need to look at the criteria. So based on to identify your lease, whether it's finance lease or operating lease, right? You look at the case now, like this one. Your useful life is 8 years. So you rented out for 8 years. So we can say that number 1, major part of economic life, all 8 years. Number 2, it says that your PV of your value is equivalent to your purchase price. So PV of lease payment substantially all to purchase price. 25.9 million. Therefore, conclusion, it is finance lease. So when you recognize as a finance lease, Able should recognize the asset and recognize lease receivable. So how you recognize lease receivable? So step 2. For your recognition, you need to calculate net investment in the list. So I have the PV of this payment. Why payment? Sorry, class. After lunch is like that. My mouth and my mind is not synchronized. That's why I keep on saying the wrong thing. So 25.9. Then we have the PV of unguaranteed residual value. So you get your 1 million divided by 1.062 in the power of 8. Must 8, because your list term is 8. So just calculate for me and then tell me what is your total. Then only we go for the amortized schedule. Okay, answer from the floor. 26.52. Since the question said nearer to 1 decimal, so I just put 26.5. Okay, thank you. So this is the amount that you're gonna recognize for your initial recognition. For your subsequent measurement, which is up to subsequent, it will be the same that you just put in your year, then opening balance, interest 6.2%. Now it's not payment, now it's a receipt, then closing balance. So 26.5 times the percentage, 4, then 24.1. So this is the amount that you're gonna recognize as the asset, SOFP. This is the amount, SOPL, as finance income. That is. Okay. Okay, yeah. So next, manufacturing for dealer. This one I'm gonna skip. So I go to the operating leases because there's not much different, just to if your dealer is part under the recognitions on the cost of sale. That's it. So operating lease. So if we cannot fulfill the 8 things which is mentioned just now, therefore it will become the operating lease. So in order to recognize, basically we just debit the cash because we received, and then we credit the rental income. So the lease payment from the operating lease are recognized as income, either on the straight line basis or any other systematic basis, which will better represent the treatment. Any initial direct costs incurred in obtaining the lease are added to the carrying amount of the underlying asset, which is applied to the same as IAS 16. So illustration 7, the lessor leases a property to a lessee under the operating lease for 5 years on the annual rate of 100,000 annual rate. So however, the contract states that for the first 6 months, it will be rent-free. So that means for the first 6 months, you don't need to pay me first, but then the rest you still have to pay. So under this one, because of this rent-free something cut off thing, so the benefit received from the asset is earned over the 5 years. However, for the first year, the lessor only received 100,000 6/12 because for the first 6 months it's free one, no need to pay first. Then the rental of 450,000 are received over the 5 years lease term. So this is like a little bit on your deferred rental payment. Rental receipt. Payment is for lessee, lessor is receipt, class. And then therefore the lessor recognize the income of 900,000 per year, which is divided by 5 years. Then the receivable of the 40,000 is recognized at the end of the year 1 because you only receive 500,000 where you have a owing, where your receivable are yet to receive another 40,000. So as a conclusion, class, because so far I didn't see any question tested on the lessor, that's why not really focus on it, but it's sometimes maybe I'm not very sure, but just you need to know that for the lessor accounting as a conclusion, right? You need to identify whether it's a finance lease or operating. Then you have to refer to your criteria. So criteria, I mean, we come to the very basic one, it will be risk and reward transfer to, let's see, this one, risk and reward, not transfer. All right. Then for the finance lease, for the accounting treatment, first thing, you need to recognize the asset. Number 2, recognize lease receivable, which is under the net investment in lease. Okay. Then number 3, do your amortized schedule to identify your finance income. Number 4, any impairment of lease receivable is part under IFRS 9. As for your operating lease, so under your accounting treatment, number 1, you will remain as non-current asset. Just now the one I said de-recognize, so the other one will be remain. Number 2, since this is your asset, kindly go for depreciation over useful life. Number 3, recognize rental income on straight line basis. Okay, so that will be the difference on the finance lease and operating lease. Just take it as a summary. Okay, sales and leaseback transaction. This one, so far is not mistaken, except for the latest one, I not really can look into it, but so far it's been tested 2 times on this sales and leaseback transaction. Right? So no matter how this it's a good question to be asked because it can involve a lot of things. So sales and leaseback transactions is situations where the entity transfer the asset to another entity and then list it back. So that means I'm the lessor at the beginning. I am the owner at the beginning. I sell my asset to you. After that, I list it from you under the lease contract. So sales and leaseback transactions. So when you have a sales, because you must dispose it now. So therefore, the entity must apply the requirement under IFRS 15 to determine whether in substance a sales of occur, meaning that whether a performance obligation is satisfied or not, right? So when it will be the situation, number one, this is the sales. That means I confirm, I sell it to you, my performance obligations is satisfied. Then after that, I list it back from you. So when this thing happen, the seller now become the lessee. The one who sell the asset now become the lessee, right? They said the carrying amount of the asset must be recognized. So meaning that since you already disposed it, therefore you will credit your non-current asset because you dispose it. Right? The seller recognize the rights of use of asset measured at the proportions of the previous carrying amount that that relates to the right of use retained. So that means calculations later on. So we go for the normal journal entry first. Debit ROU asset. After you recognize your ROU asset, that means you need to credit your lease liability. So when you dispose, you may debit cash or bank or receivable, sorry. Then when your account cannot balance, you will debit or credit any gain or loss which is related to the rights of transfer. Right? Rights of transfer. So that is the thing that you need to know. Formula, we see later on. If the consideration received for the sales and the asset does not equal to the fair value, all right, does not equal to the fair value. That means your payment is not equal to your market rate. So you will look at whether it's below the market terms or above the market term. If below the market term, the difference we will recognize as the prepayment. Right? We will recognize as the prepayment. So since it's prepayment, you would add to the right of use of asset. If this is above the market term, that means you sell at a higher price. Therefore, the amount that you incurred more, it will be additional financing. So this additional financing will add to the lease liability. Okay. This one. Right? So done your seller. Next one, buyer. The buyer now become the lessor. So we call it buyer lessor. The buyer lessor accounts for the purchase as a normal purchase. That means they will debit asset, credit cash. Right? Then after that, they will become the lessor. Since lessor identify whether it's a finance lease or lease liability. Then we go for this one first, then only I go for the diagram. If this is not a sales, Okay, if this is not the sale, that means you cannot fulfill the revenue recognition, then your performance obligations basically is not being performed, right? That means as if I sell to you, basically I didn't sell to you. The risk and reward still with me. So the seller lessee will continue to recognize the asset. But then the amount that I receive, I will record it as a financial liability. So meaning that because this is not a sale, but I received the cash, so I will debit cash, credit financial liability. As for the buyer lessor, because I didn't get any asset, so I does not recognize the transfer asset, but I will record as financial asset, which is equal to the transfer proceed. So this one quite simple. So the first one, debit cash, credit financial liability. This one, debit financial asset, then credit cash. Credit cash. So unlike this one, you see, if you are the sales, then you have to go for this journal. If you are the lessor, therefore I will debit asset, credit cash. After that, I have to split, sorry, whether it's a finance lease or whether it's the operating lease. So different have different transaction. So my diagram, this one is the summary of your amount. So if a seller transfer the asset to the lessor and then the lessor lists the asset. So ask yourself, first question, is it a sales? If you say yes, then we will go to these two. This is a summary, so I didn't write out after that. De-recognize the underlying asset for the seller, recognize the R of your asset, and then recognize the lease liability, gain or loss on sales of the rights that already transferred. As for the buyer, recognize the purchase of asset, then apply lessor accounting. If you found out this is not a sales as a seller lessee, continue to recognize the asset, but then you will recognize the financial liability, which is under IFRS 9. And for the buyer lessor, do not recognize the asset, but recognize as a financial asset under IFRS 9. A little bit complicated, and then why I mentioned it's being tested, because you need to do some calculation for that. And calculation, that means you need to memorize some things. Huh? So let's look at this question. Jardine, an international hotel chain, is currently finalizing the financial statement for the year ended 30th June 2008 and is unsure how to account for the following transaction. For 1st January X7, year end 30th June 2008. It sold one of his hotels, right, to the third party institute and then lease it back under the 10 years lease. The sale price is 57 million and the fair value is 60 million. Can you see this one? So this is below market price. So you have the 3 million of prepayment. So just now, according to the standard, this 3 million prepayment, you have to add to the write-off of asset. The lease payment is 2.8 million per annum in areas. In areas meaning that pay in year end, commencing on 30th June 2008, below market rate for this kind of lease. The present value of lease payment is 20 million, implicit rate 6.6 million. The purchaser can cancel the lease agreement and take a full control in the hotel in the 6 months notice. Okay, I mean after 6 months, then you can no right to cancel anything, so everything will become confirmed. The hotel has the remaining economic life of 30 years on 1st July 20 X7. And the carrying amount under the cost model is 48 million. You are required to discuss how the above transactions should be dealt with the financial statement of Fardin for the year ended 30th June 20X8, work to the nearest of 0.1 million. Right? So because just now the calculations of the ROU, they say you need to do some apportion. So therefore, I would like to give you some formula. You know, my class always calculation and formula and steps. So when you go for a revision, this is the step when you go for the list. This is the step for you go for the sales and leaseback transaction. So you follow the step, then can answer better. So my step 1, just to calculate this one, sales and leaseback, right? So calculate gain, which is fair value minus carrying amount. Step 2, calculate gain that relates to right transfer equals to S1 times PV of lease payment over fair value. Step 3, gain on right transfer equals to S1 minus S2. Step 4, ROU asset equals to carrying amount times PV of lease payment over fair value. Calculate, you copy first, then I will show you on how to use this formula. Okay. Now we use this part to calculate our the questions given. So you see, the Fardin, fair value, you have 60, right? Carrying amount, you have 48. Presence value, you have 20. So you already got all the information. So what you need to do, just to fill in all information. Okay. Step 1. So fair value, 60 million minus my carrying amount. So I got 12 million. Step 2, gain on the right transfer. So, which is my step 1, 12 million times 20 millions over 60 million. So I got 4 million. Step 3, S1 minus S2. So See lah, 12 million minus 4 million, 8 million. And then step 4, write object of transfer, carrying amount. And just play with this thing. So when you go all this, basically this amount is to help you to get your journal entry. So remember my journal entry, I said debit cash, debit ROU asset, credit your asset, which is hotel, credit your lease liability. Then you have the unbalanced one. So the balanced one, we reserve to the last one. So cash, I have 57 million. Am I right? ROU asset, I calculate it is 16 million. But I need to add 3 million from my prepayment, which is understated and which is under market value. So 19. My hotel, I dispose at 48. My lease liability, I got 20. And you see, my account cannot balance one. From here to here, I got 76. From here to here, I only got 68. So I got a difference of 8. So where this 8 come from? This 8 is come from your step 3. Okay, this 8 is come from your step 3. So what's my step 3 name? So gain on right transfer. So you just put in here, credit gain on right transfer. So this is my step 3. This is my step 4. So to be more accurate, step 4. So because this is your initial recognition, so I put it here, initial recognition. We always have the subsequent measurement. So my subsequent measurement, my depreciation will be 19 million divided by, okay, class, tell me, what is your useful life or your lease term? You only have 2, either is 10 years, either is 30 years. Which one? $30 years or 10 years? 10 years, because shorter, right? So always remember the word. So divide by 10 years. So therefore, my depreciation will be 1.9 million. The second one will be my amortized schedule. So just a simple one. 20 plus 20 times 6.2% minus your annual, which is 2.8. Let me calculate a little bit. 18.5. So the amount to be recognized in my SOPL, first, I have this one. Gain on right transfer. So 8 million. Number 2, I got depreciation. 9.1. Number 3, I got finance cost. It's 1.3. Sorry, 6.6%. 1.3 million. So in my SOFP, then you know like SOFP, then you have assets and liability. So this is the way that you go for your sales and leaseback transaction. So first thing I forget to ask whether it's a sales or not. Of course, you have to say this is a sales, right? Why? Performance obligations is being satisfied and the control has already passed to the third party. Especially they mentioned this line. Where is this one? The purchaser, that means the buyer after that can cancel the lease agreement and take the full control of the hotel after the 6-month notice. So this sentence tells you that this is the sales. Right? And if you talk about the lessor, which is the buyers, right? You can say that this is the operating lease. Can be. Why? Because the useful life is 30 years, but I only lease out 10 years. So I cannot get the major part. Since it is not the major part, so from the buyer side, it shall be the finance, it shall be the operating list. Right? Can? Okay, next one. So this is an example where, because just now what we did is a prepayment. So this is the example for the additional financing. So reading. Not much different, just that your finance lead later on you have to add this one. Okay. So after you become relates to the financing liability. Okay, this one, quick one. Just to check. We have 2 questions. We go for this one, easier one. I don't need a lot of things, right, class? Just to make sure that you know about step 1 to step 4 for the calculation. So please calculate this sales and leaseback transactions on the initial recognition. Okay, on the initial recognition. How long you need? I think 15 minutes. 3, 5. You managed to copy the step 1 to step 4? You want me to show you the question or these steps? Because I'm not sure whether you managed to copy or not. You want to show on this page or the question? Formula or question? Formula. Okay. Okay, very good, Dongwon. Since you already managed to get the step 1 to step 4, try to prepare the last part on the journal's entry. Then we can proceed to the real final exam, final ACCA exam. Journal entry to debit your cash, then ROU asset, your credit your building, credit your lease liability, and credit your right on gains on right transfer. So no, if no, then I just put it here. Okay, since you managed to get step 1, step 2, so I put it here, debit cash 5 million, debit ROU asset, as you calculated 1.26 million. Then I will credit buildings 3.5 million, credit lease liabilities 1.8 million, and credit gain on right transfer 0.96 million. Very good. See, basically you follow the steps, right? You manage to get, okay, that one is because it's quite straightforward. This question I will come back when we go for the next week professional ethics. So let's look at the 2020 exam. Sales and leaseback. You see, it purposely goes showing that this is sales and leaseback and improvement. So you have two items. One is sales and leaseback, then the other one is the improvement of your stadium. And the question required on 3 things. And you look at the marks, 13 marks, which is quite heavy in the sense that you have a lot of things to write on this question. And he said, discuss with relevance IFRSs. Number 1, whether the directors can classify the stadium as held for sales. It again asks you whether it's a held for sales or not. Number 2, Laria accounting treatment for the crowd barriers improvement at 31st October 20X5. That means you need to tell the examiner whether they did it correctly or not. Number 3, the principle of the accounting treatment for the sales and leaseback transactions of the stadium at 30th November 20X6. Since we have different dates, class, so you have to make sure you know what is your financial year end. Okay, your financial year end. And then which will be your cutoff. Because 2 required on 31st October, then 1 required on 30th November. Which is after 1 year's 1 month. So you need to look at the date carefully in this question. So based on this one class, because we have not much time, not much time now, because this one need a lot of calculations as well. So 3 things that you need to know: held for sales, accounting treatment for the burial improvement, and then the number 3 will be your S1 to S4. So try with this one. You have 15 minutes. Just to read the question itself already take you 10 minutes to understand the case. So that's why you have 15 minutes to read through, then highlight those important things. Then I will show you how this question trick you with the date and the requirement. Okay, class, save a little bit time. So just go through this question with you. Have you read the question? How you think this question is difficult to understand, or you cannot analyze, I mean, you cannot get the information from the question? Is it difficult, this question? Okay, never mind. So let's look at this question. Because it's required three things, so I put in a question over here that when you answer this kind of question, when you classify as half or sales, ask yourself yes or no, and then why you say so. Always ask yourself why you say so. What will be your evidence to support your answer? And then number two, crop barrier improvement, correct or incorrect? Because it's assumed for the accounting treatment. So when you say correct or incorrect, then you have to say why you say so, and then how you gonna account for it. Why this one including how you gonna account for it? Because it include the figures, the calculation. That's why you need to tell the examiner how you're gonna do. If this is correct, of course, no adjustment, no need to reverse or revise the transactions. But if it's incorrect one, then how you gonna account for it? And then see later on. So we go to these two first, because this one is on 31st October 20X5. So on the question, Realco is an international successful football club. And Realco is preparing the financial statement for the year ending 31st October X5, but currently facing liquidity problems. Liquidity problem, that means not enough cash, right? So Realco has entered into the contract regarding his stadium, whereby it will sell the stadium on 30th November 20X6. Plus, you see, you are preparing the financial on 31st October, but your sales is gonna happen on 30th November. So from this one to this one, because the question asks whether you will classify as half or sale, the first one is already more than 12 months. Okay, already more than 12 months. That's the first thing. Then it's further mentioned, the directors of Relia wish to classify stadium non-current as a held for sales in the financial statement on 31st October X5, as they believe the sales to be highly probable at the date. Right? The sales contract requires the disposal of stadium at its fair value, which is 30 million, and the Liria lists it back over the 10 years. The present value of the lease payment on 30th November 20X6 will be 26 million. So from here, you have one fair value, this one, lease payment. The market value of the stadium this time have not changed in several times, so it is unlikely to change in the near future. And the depreciation is 5% per annum using the reducing balance. So far, so okay. Huh? So now we talk about the barrier. In the year to 31st October X6, okay, just now is X5, 31st October. Now it's 31st October X6, all right, which is 1 year after. It's anticipated that 2 million will be spent to improve the crowd barriers in the stadium. This is no legal requirement to improve the crowd barriers. And Realco has incorrectly treated it. See, the question already tells you incorrectly, though definitely it is wrong. Okay, so incorrectly treated this amount as the reductions of the asset carrying amount on 31st December 20 X5. Wow. That means the thing's gonna happen in 20X6, but then the company record it is the 20X5, so it will treated 1 year in advance. all right? And the corresponding debit has been made to P&L. And at 31st, so that means this one, you see how the question trick you. They will debit P&L and then they credit Stadium. How I know they credit Stadium? Because it said reduction. Reduction, that means you reduce the value of your asset of 2 million in 20x5. And then they also saying that this 2 million, right, at 31st October X5, the carrying amount of the Stadium after the depreciations and reductions in the crowd barrier is 18 million. That means you already underestimate it. All right, you already you already minus the 2 million, which is inappropriate. That means your assets already reduced by 2 million. So definitely it is wrong. So you need to add back the 2 million into the Stadium. And then the Stadium crowd barrier is happened in the year 20x6 because it says that now anticipate the 2 million spent to improve the crowd barrier. And your sales is happened in 30th November. That means after 1 month, only you can sell it to the third party. So meaning that in your year 31st October 20x5, the conditions of your Stadium is not immediate for sales at the present condition. So therefore, for the first one, my answer, not eligible to classify as held for sales, right? Because your sales, first, number one, sales at 30th November 20x6, but financial year end 31st October x5, which is more than 12 months. So it's not highly probable. Number two, because you have the barrier improvement, to be made in 20x6, meaning that immediate sales for present condition is not satisfied. So because of these two reasons, therefore cannot classify as half of sales. Okay, cannot classify as half of sales. Okay, number two, this one definitely is incorrect because the question already tells you, and you can say that this is no present obligation. First thing, because we talk about present obligations right here, there is no legal requirement to be improved. So, and then it's also incorrectly treated as a deduction. So this is no present obligation to be recognized. So basically, no need to do until you spend for it. Because the spending is on 20x6, but the company record it in 20x5, which is inappropriate. So therefore, we need to remove. Okay, so how we gonna account for it? So account for it. Number one, the 2 million should be treated. It should be reversed. Should be reversed in 31st October x5, as it would be the expenses or spending for 20x6. That means it's not happened yet. So therefore, you need to be reversed. Since reverse, debit, stadium, 2 million, credit B&L, 2 million. And because of this one, the carrying amount of stadium at 31st December, 31st October X5 should be 18 million plus 2 million. So now we calculate the carrying amount of stadium at 30th November 20x6. Why I need to calculate this one? Because the question didn't give me. It is not mentioned by the question. The question give me fair value. The question give me lease payment, but the question didn't give me carrying amount of the stadium. So I have to calculate myself. So CA at 20x5, 20 million. So minus my depreciations, 5% for the year. Because it said after. So I need to recalculate on this one. So which is 5%, 1 million. So I got, sorry. All right, 20x5. So by 20 CA at 20x6 will be 19 million. So 19 million, this is on October's, right? So I need to calculate for depreciation only for November. So 19 million times 5% times 1/12. So 0.08. So I got 18.92 million for my carrying. So class, now I got the carrying amount, I got the fair value, I got the cash, I got the payments list. So next one is the part 3. The principle of accounting treatment for the sales and leaseback of the stadium. Okay, so before I go to the explanation class, again, step 1 to step 4. Okay, I don't need the step 1 to step 4. I need the journal entry. You give me the journal entry. Then consider the class. I mean, I can conclude today's class is done. So try this one. I repeat, I need the journal entry. Pick one. S1 to S2. Basically, if you follow the step 1 to step 4, you can manage to get the answer. Because that's the reason it's been tested, because of the difficulties on the step 1 to step 4. But once you formulate it, then you'll find out that, hey, basically it's not very difficult. So you just follow the step, then you manage to get the answer. Right? You calculate. Can? So you see, I just proceed. So if it's the sales, so you have to answer to the examiner, yes, this is the sales. Why you say so? Because of the statement over here. Enter into the contract regarding the stadium. So that means it's already have a sales commitment, right? So sales commitment. And next one, accounting treatment for the stadium. So after you calculate your step 1 to step 4, you can go the debit your cash of the stadium, 30 million. Debit your ROU asset of 16.4 million. Credit your stadium that you calculated 18.92 million. Credit your lease liability, 26 million. And then the last one, credit gain on right transfer. $1.48 million. So where you can get the answer, then you just tell the examiner saying that because this is a sale, so reader should number 1, D, recognize the asset, the stadium, right? And then number 2, recognize the sales because 30 million, because I have to relate to the case, right? Number 3, recognize ROU asset, which is based on the proportion of the carrying amount. Then number 4, recognize lease liability. And then number 5, recognize gain on right transfer. Long question. So you see, this is how the ACCA will do when they come to the question. That's why this question worth 30 marks, because the information links here and there. So therefore, when you split, when you read the question, if you can like split out all the information according to what you want, then it will be much more easier for you to analyze the question, and then you manage to find the evidence or information that you need so that it can help you to answer your question. Right? Can? I will upload this one once I touch out a little bit, because I found out I got something empty. So once I touch out, I will upload the answer in the Microsoft Teams, right? Any questions so far? I know I got a lot of things, question to be done. I think question will be good lah, just to help you when you go for a question. So any question, class, so far? Next week, we will go for share base and then the professional ethics plus the remaining things, if I got the time, right? Then for the IRC, as I mentioned, I will update you all the latest 3 standard. So any questions, class? If no, remember to sign your attendance, and I will see you next week. Thank you. Bye.